Henry says collar spread versus the married put. Is the married put superior? Why? I'm going to say the married put structure is superior done in the context that we use it in, the radioactive trading technique, buying the stock, buying a put far out in time, as we just saw for Don, looking at those different structures and positions. If, Henry, you were doing just a standard married put, what do I mean by a standard married put? Buying a wasting asset that's out of the money in 30 days out in time. Buying AstraZeneca at that price, but buying an out of the money put for June that's only $1. In that case, I'm going to tell you the standard collar is superior to the standard married put. But for me personally, the radioactive married put approach is superior to the standard collar in most conditions, but naturally, we could see better collar returns in the right market conditions in a shorter time frame, 20 to 30 days. All right. Which one do we want to use? Let's take Ashland. Why not? And I said with Ashland, going into the January expiration, going into the search by symbol tool, my preference would probably be this 5% in the money, 6.6% at risk for Ashland. And I'm just going to open the profit and loss chart here. So we know what we're looking at here. We've got our married put structure. We have protection all the way out to January. That's only 5.8%. Now that's the worst case scenario for 238 days. Unless the stock falls 15 to 20% in the next month, Henry, has a steep decline, maybe down to 100, the only way I'm going to realize that full maximum loss on this Ashland position is if I hold the stock all the way to January, 238 days out in time, make no adjustments, and accept no dividends if Ashland pays a dividend. If I hold it all the way to January, the stock's below our strike price of 115, all-time value is gone, we exercise our put, we have the maximum loss of 5.8%. We have a cost basis of $12,204, a guaranteed exit of $11,500. Worst case scenario at January expiration, maximum risk is 704 or 5.8%. Now, let's take Ashland. And what I'm going to do here is I'm just going to go to the custom spreads. I know we're already in the profit and loss chart, but I'm going to open 3 different profit and loss charts. I'm going to go to Ashland, and we're going to buy 100 shares of stock, and we're going to buy a cheap 21-day out monthly June put. Yeah, let's go with that. So it'll only cost us $1.40 instead of the price that we had to pay, that $11 or so. Or maybe it was, I'm sorry, but it was $14, I'm sorry, for the put option in January, the in the money put, the proper structure. This is a 4.9% total risk on the position. We keep the cost basis down to $11,000, $108.84 for the stock, $155 for the put at midpoint. We have 21 days. If the stock falls below 105 in 21 days, we'll be at a loss of 4.9%. However, we have a closer break even in this case at 110.39 because we only added $1.55 to the position. So on June expiration, if the stock's at 110.39, we're at break even on the standard married put. And this is a wasting asset. It's out of the money, so it's all time premium. That 155 is all time premium. If the stock stays where it's at, Henry, or it starts to move up, this is just going to get lower and lower and lower and lower. We started with an in the money put on the standard married put position. Now let's run some numbers. We know if the stock's anywhere below 105 at expiration, June expiration, we're going to be at a loss of 539. Okay, that's pretty steep. If the stock just meanders about a bit, let's say it ends at 107.50, so 108.84, let's say it drops a little bit, we're going to be at a loss of 289 on this position because the put's still going to go to 0, and in that case we lost 134 on the stock. And let's say the stock goes up to 115. Well, we lose everything on the put, we gain $616 on the stock. So that's a gain of $461 on the position. That's for that married put, the standard married put for June. Now, as you can hear me scribbling, you know what I'm about to do. Let's go to our other standard married put. That's not where I wanted it. This is it. Okay, so it's 1320. I'm sorry, I read my numbers wrong. 1320 for the put. We're paying a lot of money, but this put's not going to go to zero in the next 30 days. It's going to retain most of its time premium that we paid into it. The time premium is 704. That other 620 is the intrinsic value from the stock being at 108.84. And based on the rules in the blueprint and the proper structure, the at the money bell curve rule and the time decay curve, this is the structure that we would prefer to use. Same situation, but let's go to June expiration. The 17th, right? Yep. What happens if the stock's at 105? We're at a loss of 249. The put moves up in price, whereas the 105 put we bought for June would have gone to zero, remember, for the cheaper put, 1 month out, standard married put, and we would have had a loss of 539. Stock goes up to 107.50. June expiration, we're at a loss of 146. It was 289 for that standard cheaper married put position in that case. What's happening here? We lost a little bit on the put, $12, and we lost $13.40 on the stock. We would have lost the full $155 on the June put. The stock's at 107.50 because it would have expired worthless. Now, naturally, if it goes up to 115, we are going to see more profit on that standard June married put that was out of the money and the cheaper cost. Remember, it was $461 expected. And okay, here we're only at 227. So this is one of the if the stock went up to 115, would I make more money on that cheap June married put position? Yes, but when I open a married put, Henry, it's because I have the expectation that the stock is going to move up 4 or 5% in the next 20 to 40 days with the potential to move up another 4 or 5% in the following 2 months or so. All right, we're looking for a target of 7 to 8% gain over a 3 or 4 month period. That's why we're opening. We're not looking at something that we feel has the potential to run up 10 or 12% in the next 20 days. To be honest with you, those days are probably gone. We saw a lot of that during the pandemic, the pandemic darlings, the big tech stocks. Those days are kind of gone right now. Okay, so we're not expecting many stocks to do that in a 5 to 10 day period unless it's prompted by a major earnings surprise, which we've seen a lot in both directions in the last couple of weeks. Now, that's the standard married put. This is our preferred married put, excuse me. Do I make as much on the upside if the stock moves up? No, because I paid more and I'm losing on this put. But is this put going to zero? No, it's still retaining most of its time value. And remember here, we're at the 115 put. At this point, I can adjust this put option and lower my risk by using the different income methods in the blueprint. On the standard collar, you got a good profit of 461. That's great. But now this put's gone. You want to stay in this position to July? What do you got to do? You got to buy another cheap put for $1.50 or $2 out to July, and now you're paying and increasing your annual cost basis on the position. Now to a standard collar, which would be my preferred approach in this situation, but I don't know if I'd use the 105 put. That's a little bit too close, but we're going to keep with it because it's fair. And in the standard collar, I want to have a premium, so we're going to bracket the collar dead on point here, Henry. We're going to sell the 110 call for June. I'm going to get about $1.95 at midpoint. Remember, we paid $1.55 here, so we're only getting 40 cents of positive premium, which will help the break even a little bit. Yeah, I could tell you this isn't the structure I'd use. We're going to look at the next one in a moment. But here we go. Here's our standard collar. Just at, slightly out of the money call. Usually I buy a deeper out of the money put, but here it's about what I look for. Almost. It's a 1.4% profit to the upside. Have to expect that. Remember, these are lower volatility options as we saw. We're on a volatility of 0.25, 0.29. And the max risk is 3.2, about double. Typically, what I look for is about a 2 to 2.5% return if assigned on the call, with taking a risk of only 4 or 4.5, but it's about double, sometimes a little bit more than double. So this structure might look for something a little bit more, but let's say with this structure for our comparison. What's our comparison? What happens at June expiration if the stock is trading at 105 to our put strike price? Call expires worthless, put expires worthless. We have a loss of 344. Even with some of that premium coming in, the collar is at 344 loss. It was 539 for that June unapproved married put position just 1 month out. It was $249 for the preferred married put structure following the rules in the blueprint. Now, what was our next line? 107.50. Stays right about where it is, drops a little bit. What's going to happen? Call and put are going to expire worthless. Hey, we keep the 195 premium. Fantastic. We lose the 155. It's okay. We're down 134 on the stock. Countered most of it. It's only a loss of $94 in 30 days, 21 days. Okay, so we were at a loss of 146 with our preferred married put, a loss of 289 on the 1 month out married put. Stock does what we want, goes up to 115. I know I could have just used 110, but we're going to use 115 in this case. What happens here? Well, remember, your gain is capped in the collar. Let me adjust that for you, Henry. There you go. Gain is capped in the collar. So the stock goes up to 115. The most we can make is that 156. We get assigned to the stock at 110. Put expires worthless. We make 156. Profit was 461 on the 1 month out married put, and the profit was 227 on the preferred radioactive trading married put structure farther out in time. So what I'm attempting to illustrate here, and I know I don't have a table. I might add a table comparison in this, Henry, at the end to show you what it is. But the preferred married put here still can realize close to 50% of the profit you expect on just stock ownership alone as it moves up. Because our delta started out at probably only 0.55, 0.6, somewhere in that range. So as the stock moves up, the delta is getting lower. We still expect to make 50% of that profit to the upside. And we saw as the market fell, because most of this is time premium, it's not going to zero. If the stock's falling, your out of the money put for just 1 month out is gaining, but it's also losing time value rapidly because it's at the end of the time decay curve. That's why we don't like using the 1 month out cheap out of the money put structure for married put. We like to go far out in time and in the money for the best control, even in uncertain markets. As you can tell, I wouldn't like to use the monthly married put, but when would I use this structure as opposed to a married put? This might be a decent time to consider a standard collar. I want to check the other structure, though, to see here. Instead of the 105 put, we're going to use the 100 for June. You could go out to July, too. Just longer time frame and a little bit more premium. Oh, no. No. Too much risk. I was afraid of that. Yeah, that's too high. I'd probably have to stay with the 155 structure, personally. For 21 days, 7% risk? No, I'd rather go 238 days out and take a 7.5% risk on Ashland as opposed to 1 month and having a potential 7% risk. We're going to stick with the 105. This is due to that low volatility, but okay. You want this sort of 1.5 to 1 ratio here, 1.4% to a 3.2%, 2.4% to maybe a 4.5% risk, something along those lines if possible. But in any case, we've just come off of 7 weeks of negative market. We know that. We talked about that a moment ago. We've had 4.5 days of, well, 4.5 days of upwards moving market to buck that trend. Is the trend going to continue for the next week? Do we think we've hit the bottom and we're coming back up? I'm not sure. I'm going to be honest. I'm not making a prediction. I'm just saying I'm not sure. To me, this collar approach, if I'm saying, hey, not this stock, this is not a direct recommendation or suggestion, but if I'm saying we're seeing some bullishness, I don't want to be faked out again as I was earlier in the year. I want to set up something where I can control risk but still make a decent return for 15 to 20 days out in time. This is a good approach to use for a collar. And if it works out how you expect, whether you take assignment or not, or if you want to roll the call, But now, after 20 days from now, you're feeling more bullish on the market. Maybe you can convert that one you just used as a standard collar position for only 1 month out into that longer term married put structure, following the rules in the blueprint after you've pocketed maybe 1.5%, 2% premium, or let it get assigned and then buy back in the stock and restructure it as a married put. The structure we prefer is more for long-term growth, long-term expectation, and to really help us, as you saw when we ran those examples on the farther out in the money married put, following the rules in the blueprint, mitigate market volatility. Even with declines going down, we have less of a loss than you would in the standard collar position, mostly, except for that 107.5 strike because you took some premium in. But remember, if I opened our married put that I'd want on Ashland and the stock moves up to, say, 110 or 111 in the next 10 or 15 days or even 20 days, I can start selling good calls against it, the July 115, something along those lines, or do other adjustments in that scenario to continue to lower this initial at risk, lower this break even, which again is only out to January expiration, and increase the profit potential on the position. But if you're more concerned, you're not sure if you think we're really bullish yet, which again, I said I don't, but married put is a good structure to use, but you could always take a flyer with a low risk collar. And yes, if the stock stays right between the two strike prices I mentioned, that 107.5, you could rebracket the collar for July. So the July 110 and buy the July 105, depending on what the numbers look like for you there as well. Okay, that's what you can look at, Henry. That's how we approach the married put versus the collar. The married put, in my opinion, is superior, but it is designed for longer term growth. If you're concerned now that there's still volatility in the market, you're not sure that we've rounded the curve, that we're going to stay neutral or maybe a little bit more bullish, or you think it's a fake out and we're going to go back down, maybe the collar isn't the right approach either. What do I mean by that? These are both neutral to bullish strategies. But if you're thinking you want to make some trades, I'm not saying necessarily open a covered call. I'm not saying open a 1 month out married put. I'd prefer to see going into a standard collar position like we're showing here, or longer term married put with longer term growth expectations as well. So Henry, that's the best way I can ask that question. All right, so sorry about that, folks. What I just wanted to remind everyone, of course, my apologies, there we go, is that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or trading suggestions. Options, as we've seen, involve risk and may not be suitable for all investors. Now, today we had a chance to look at some of the search tools. Took a very brief view at the portfolio. The beginning of the presentation was dominated by our discussion on strategies and so forth. But if you like the tools that you saw today, just go to powerop.com, put in your name and email address, and start my trial. You have full use of the site for 14 days, no credit card required. You'll have access to the patented search tools, our various signature tools, the portfolio tools, and much, much more. After the 14-day free trial, subscriptions start at only $45 per month. That's for the end of day service, but the delayed service, 15 to 20 minute delayed data and all the search tools, analysis tools, portfolio, and more is only $65 per month. And then, of course, you can have the delayed service plus full access to the historical suite of tools, historical change, historical search tools, and search by symbol. And that's just $35 more. So it's $100 per month to go up. And we also do offer a real-time service and the premium service, which includes everything, including access to the API. And we talked about some of the free education available on YouTube there. You can check out the different playlists or the standard videos. You can also check out the free webinars on power options, the webinar archive on power options. You can also check out the blog or the learning center, as we just did on that last discussion, to see the mean prices, market activity, optionable stock statistics, and much, much more as well. And of course, just a reminder, as we talked about a little bit ago, you do have any other questions at any time, please send us an email to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And any trial member or subscriber can schedule one of those coaching sessions, a free 35 to 45 minute phone conversations with myself or Ernie. We'll walk you through the tools on the site, answer any questions that you have, just like we do today, but it's usually done over the phone as opposed to during a live presentation. But you can request, if you schedule a coaching session, you can request to use GoToMeeting so you can see my screen and you can walk through it as we're doing here today.